All right, man. So we took a walk not too long ago, or just had a conversation, and I think it just came out because we heard some more and more news. There's been a lot of news in the last 6 weeks or so of just some gigantic tech companies now starting to pay a dividend, and we're starting to see almost this like seismic shift in the market of what used to be traditional is now expanding.
Yeah, it's funny because we're such big fans of dividend paying companies. When you hear the word dividend, my antenna goes up, and I'm like, what? Yeah. Who's starting to pay? And honestly, if you would have said who would be the first to pay a dividend
on the tech
side
NASDAQ
that hasn't already, and some of those companies, they've been paying them since the 90s and stuff, it would have probably been like an Amazon.
Yeah,
I just see them more as that traditional type company that would, quote unquote, pay a dividend.
Yeah,
but the two in the last 6 months or 6 weeks, I did not see that coming at all.
Me neither. So Kyle Morgan's with us today, as you're on here all the time. But one of the big things that we want to talk about today is really this interesting shift of where the traditional tech companies of NASDAQ, who have just been the growth, companies that take all their free cash, put it right back in their company, are now starting to pay. Now, albeit it's not very much of a dividend, but the reality is they're beginning to pay more of a dividend. So we just kind of want to talk through some of that. So let's discuss right out of the gate here, like we do this often when we start talking about dividends, but what exactly are dividends?
So a dividend can be a payment that a company declares. Most of the time it's quarterly, and it's a way for the investor to share in the profits of the company. That's
one way, it can signal one of the things I love about dividends is, you can look at the stock price as like an emotional indicator of what's going on. You can look at the dividend yield or what they're paying as strength of the actual company. Like, you can't pay out a dividend if you don't got cash.
That's right.
It's such a great indicator of the company. What else?
It's really like that, the heat check on their balance sheet, right?
Yeah.
If they're actually producing cash or if they're just burning through it.
You really want to know how a company is doing financially, look at the history of their dividend payment. If it's sporadic, their balance sheet's probably sporadic. If it's been consistent, their balance sheet's been consistent. They're managing their cash flow well, and the strength of that company is not always.
Right.
You can always be blindsided, but it's pretty good. It's a way for companies to attract and retain investors. It can be tax advantage income, because sometimes when you're in this cycle of needing income and stock goes up and down, sometimes you might get caught in a situation where you're doing yourself a disservice by selling shares instead of just taking a dividend.
You get a lot of tax advantages too, even as if you're in leadership and you're paying out cash dividends, those get taxed at a most of the time a significantly lower tax bracket than what you're probably in if you're an executive.
So another thing we want to talk about is really contrasting sectors that are known for paying dividends, because this is a brand new sector. I mean, some companies in tech have paid for a long time, like a Microsoft, right?
Yeah, it was in the 90s, right?
Very, very long time. But that was really the odd man out. And, there's some other sectors out there like utilities. Utilities are just, when you think of dividends, you think oil and gas. So utilities, they're stable companies, they're highly regulated.
Yep.
They all have really strong dividend policies, and that's something, of a sector where it's just almost a mainstay.
There's so much research and that they're doing from that utility company. So they're seeing years out. So their balance sheets are really there's not a lot of volatility that's happening within them.
Well, their price of what they can pay for or what they can charge a customer is so regulated.
Correct.
They know almost like you're saying, a couple of years out, what their profit could potentially be. They're still trying to figure out how to make more, but at the end of the day, because they're so regulated, it's so attractive to a dividend investor, because they know what they're going to get and they can track their performance very, very well, because they're not going to be those outlier 700% years, you know, it's going to
Correct.
be that consistent year-over-year growth because of government regulation.
Yeah. And another one that we like is the consumer packaged goods. Yeah. And they're, you know, less regulated for sure. But most of those companies, like a Procter and Gamble or I'm blanking on a couple of the other, like even
General
Pepsi
Mills,
and General Mills,
Coke.
like they're just so spread out. They have their hands in so many different avenues to create income.
Well, the thing I love about consumer goods is like if you go back and remember the pandemic, one of the things I loved is like the staples of America. I called it middle America. Like they're not going anywhere. You know, the world shut down and consumer goods is, you know,
you're
like
still going to buy your Coke in the afternoon.
Yeah, utilities, most of utilities were good. You know, gas companies struggled. But then you noticed CEOs of huge companies like Exxon coming out like right when the pandemic was at its worst going, we're going to do whatever we have to do to pay out our dividend. He just set the standard. He's like, we are not cutting our dividend. We are paying it. And oh, by the way, like it was a couple months later, we are increasing our dividend. And yet gas usage just came to a screeching halt. Going back to consumer goods, the thing I love, and this was the point I was making, is they're always in demand. Like, it's never going to be a time where you just don't want to eat anymore.
Right.
You know, you might want to go on a diet, you're still going to eat.
And they probably own the diet food that you're going to try. Still going to brush your teeth. You still got to have paper towels to dry your hands. Like, those are always great ones.
And now you've got a new sector that's coming into play, and it's the tech sector. You know, the tech sector of old, high growth, fast pace, no yield, no dividend. You know, I will use my cash to grow this company. We're not going to pay it out.
And maybe do some share buybacks.
Maybe.
You know, even those were kind of speckled in there.
Totally.
Yeah.
You know, the reinvestment back to those companies, the tech sector, was done to expand their footprint, you know, to grow their company. They didn't want to share profit. They don't mind sharing expansion and growth of the stock.
Right.
But it was never, you know, hey, we're going to pay this out, which meant high volatility. Because if you look at the traditional dividend payer stocks, there's just this underlining, not stability from the standpoint of there's no volatility, but the volatility typically in a very mature dividend stock is just far less than a even mature growth stock or tech stock. You look like an Amazon or an Apple pays, but if you look at an Amazon or a Tesla or something like NVIDIA, you can see these violent, you know, awesome experiences where it just goes straight up. And then on the flip side, you can see it lose 40%. I mean, the last 6 years, there's been drops of 40 and 50% in some of the most mature, largest companies in the world that don't pay a dividend in these tech sectors,
right? Which
is just the norm.
Yep. And that's what you're just having to endure.
You know why? So here's why. If you think about a dividend paying stock versus a non-dividend paying stock. So let's just say a mature dividend paying stock, you know, like an Exxon or a consumer goods company. They are paying, let's just say, a 5% yield. Let's just say the stock's $100. That means you're getting $5 for every $100 that you have, or for every 100 shares that you have in the stock. What's actually happening, it wouldn't be 100 shares, it'd be one share. But what's actually happening is when the stock has volatility, you're like, I'm not selling because I'm getting paid to hold it. So as you have, you know, $100,000, $1 million in dividend paying stocks, you're getting paid $50,000, $60,000 a year just to watch its volatility. But you're like, hey, I need that money to live.
Right.
Flip side, you have a growth stock and you ride this wave up. You're not getting paid. There's nothing holding you to the fire. So as there's volatility, you're like, the buy low, sell high mentality comes into play, where the dividend, it's not. Because here it's like, yeah, I want to buy low, but I need the cash.
Yep.
On this side, you know, there's volatility, things are going happening, and it starts to slide, and you're down 10%. You're like, man, I got no reason to keep this stock. I'm just going to sell. I'll wait till it settles down. I'll buy again.
Right.
That is imagine. This is not what we do, but can you imagine, for those of you who are retired, you know, having to play this game? And we just went to Vegas a couple weeks ago. And I almost want to feel like it's that. It's the stock market. It's legalized gambling to a degree.
Yeah.
And the stock has this volatility, and you're like, I want to buy down here, I want to sell up here. I'll take some profit and live off of it. I got to do that every single year, and hopefully my gains outweigh my losses.
Yeah, and I can keep replenishing this bucket of cash that I'm living on.
What an anxiety-ridden, portfolio style of man. I mean, I did it still, actually, up to this point in my career. I've been in here 25 years. It's almost 50-50 where I did that style of management, and it is just so hard to get right. And I would liken it to like, a football team. You would have to build a dynasty from when you need income to the day you die, where you're always picking the right players to hit the Pro Bowl, to put you in the championship game, or at least get you to the playoffs.
Yeah.
A dynasty is a winner, though.
Sure.
So, you have to have a championship caliber team that at least gets you to the championship game every year throughout retirement. My blood pressure's going up. I wish I had my heart rate. Just thinking about that.
Yeah.
Like, that is so stressful.
I mean, and think about the best, like, arguably, like, one of the best dynasties around that, like, following that through was the Patriots. And they were only able to sustain it for about, 9-10 years?
Well, if you go back to
like
his
that
first
window,
one, it was almost 20 years, but because I think he won this first
but
one
they had 5 or 6 years where
they didn't do
were
anything.
Nothing.
Yeah.
And then they had to kind of rebuild it again.
And how stressful.
I mean, you can't do that in the middle of retirement.
Yeah.
Hold on, I need 5 years to kind of
recalibrate.
Get it back. You're like, no, what do you call it? The death spiral?
Yeah.
So, like, that's just not a.
So, what is the death spiral?
So, the death spiral, if I understand the definition correctly, is basically every year you know that you have to take out a portion of money to live on. And the death spiral starts when those years of your return are not helping you recoup what you're taking out to live on.
Yep.
So let's just say you need 4% of your account balance to live on for this upcoming year, but your return on your portfolio is only 2%.
Or negative.
Even worst case. Well, now what do you do the next year? You didn't make enough to recoup your 4% that you took out. You actually lost money. And now you need a higher percentage of that. It's no longer 4%.
Yeah.
You might need
5.5%.
5 or 6%.
So and
then you're down.
You just slowly started that spiral.
And if that's early on in retirement, you've got 20, 30 years, you think, in retirement, that's a bad situation to be in.
That
would be scary. That's not the advisor I want to be.
No.
Is telling you, whoops, we screwed up.
That's where that dynasty gets brought down to reality.
That's right.
Real quick.
Yeah.
Right, next thing.
Circling back. Yeah, I was just gonna say, circling back to some of these tech companies, and this is I pose it as a question, but I think it's more of dialogue. Do you think some of these tech companies, now that they're reaching valuations of
Stupidity.
$2 trillion, like
crazy,
it's just insane, like their ability to grow by a 30 or 40% year over year, like it's so hard to do that when your market cap's so high. Do you think maybe that they're seeing like, hey, we're going to get out in front of this a little bit because it's unrealistic for us to think we can give another 20 or 30% again?
I think to some degree, you're seeing some of those companies super flush with cash, not seeing enough opportunity to use that cash to get those 30% growth, where they can attract a different style of investor and have more stable return. Because I'm sure these companies, these owners, the board of directors, the shareholders, don't want to continue to see. If you think 2 or 3 out of the last 6 years, these companies have had to reset. I mean, because their valuation or their stock prices dropped by 30, 40, 50% a year in those 3 years. Out of 6, that means they're doing this.
Correct.
And, they're just getting to that point where we have, billions and billions and billions of dollars. And you can either take flyers and crush your company and continue this fluctuation, or let's attract a new set of investors that isn't going to jump out, and we're not going to see this massive fluctuation, because that's where the fluctuation comes from. Like when the people start getting out because they have no reason to stay in, the stock slides a lot faster.
Sure.
And you see these big run-ups, and then you see these big sell-offs, and you see these big run-downs. And when you start paying a dividend, there's a lot of people that are like, no, I'm just going to stay here and get paid.
Yeah.
And I'm in it for the long haul because I believe in this company. Like to your point on Amazon. Like, they're the next one. Like,
they have to.
They got it. I mean, they're so big.
Spending a ton of money on infrastructure. And that's a little different than Google and Meta, who are the most recent.
Who just have so much cash.
Yeah.
And I feel like Facebook is just, and I've said it many times, they're just wasting cash.
Yeah.
And their stock price is coming back down to reality lately. And it's the biggest push you see is they're just continued waste of cash on things that are probably 10 years away from really taking off. Now, they might either be way ahead of the game, or companies are going to come out and figure out something before them, and they've just wasted time. I think the best product they got is the Ray-Ban glasses. And
Meta's
nobody's
product?
even touching them. That's way better than the virtual reality, what do they call it? Metaverse. That makes everybody sick.
Right.
Like, I've bought 2 of their products, and both times, like 20 minutes in, I'm like, I'm nauseous. So until they can figure out how to not get people nauseous, or the masses nauseous, because not everybody does get nauseous. But even my 13-year-old son puts this product on, and like in 20, 30 minutes, 40 minutes, he's like Dad, I'm getting these massive headaches.
Yeah.
And that's why their sales have already slumped. And it's the biggest reason is all you read online is it makes me sick.
Wow.
So until somebody figures that out, but yet they have these cool glasses that are, in my opinion, total invasion of privacy, because you can record all kinds of stuff and nobody knows. And, you can zoom in, you can do all kinds of like really cool stuff and see it in your eye. But you're in reality, you don't have this thing on your head. I would hope that they would spend more money on that, but they're not.
Yeah.
They're spending like nothing, and they got this cool brand, and all the money that they're spending on the metaverse, and they're getting 5-year-olds.
Right.
How are you going to make money? I guess you can.
Yeah.
I'm not going to pretend to be smarter.
Sure. It'll also be interesting to see how, like, what the future of their dividend looks like too.
It's so tiny.
Like, and what do? Do they just keep it level and it's like, hey, we're paying one, woo? Or do they actually make it part of who they are and consistently increase it a little bit? Like a Microsoft. Like, they're on the verge of becoming an aristocrat, which is someone who's paid their dividend for 25 years or more and increased it over that time. Which is kind of cool that Microsoft is one of those.
Working its way into that.
Yeah.
I mean, they're only started paying since 2007, but they have increased it every year. It's a bedrock of who they are. Nobody thinks about Apple as a dividend payer.
No.
But they have been.
Right.
Because it's just so tiny because the stock price has gone up so much.
Yeah.
All right, let's talk about the tech relationship with their capital. So really and we've already touched on this, so we're going to go through this pretty quickly. Most tech companies are innovation focused. They're trying to future-proof their investments with R&D. Their whole mantra is reinvest, never pay out.
First. You've got to be first. They've been fighting for ad dollars and
if a company comes out first, we're gonna buy them.
You're right.
We're
getting in trouble for a little bit.
Yeah. We're gonna basically just buy any competitor. That's the name of the game right now.
Squash them and
it's not even
put them on a board seat.
Absorb them.
Yes.
And use that tech to grow, and that's served them a lot well. Government wants to get involved at times with that and be like, you can't do that. And yet they'll let other huge companies, whatever. Scaling operations, so rapid expansion, global reach.
And that's really like Amazon, right?
Yeah.
Like you see Amazon. But you look at probably their biggest competitor, Walmart, and they're one of our favorite stocks, who is a dividend payer.
Yeah.
So it's kind of, you can see two sides of it there.
And you can see like a Walmart trying to break into Amazon's, consumer. They're getting better, and I would say they're probably their biggest competitor in that space. And Amazon has more to lose than it does to gain.
Correct.
Because they're so big that if they don't look over their shoulder constantly, I mean, little by little, you're going to have all these Alibaba and all these other big companies that are just going to be like, all right, we're going to take some of your market share. And Walmart's probably one that's ready to pounce because they've been steady Eddie.
Well, and they've been spending, 40, 50 years building out the infrastructure that Amazon's been trying to do the last 10 to 15.
Yeah.
They're like, we already have a neighborhood store everywhere. So we're just having to put in some coolers and lockers to store things, where Amazon's having to go build out these huge distribution centers. And,
I was taken off 2 days ago, and the plane, you get to the runway, and then it's always like this. You do that little U, and we're sitting in the U part, and then there's this huge, gigantic double-decker plane getting ready to take off. And I looked at my buddy who's sitting right next to me, and I was like, look at that. I was like, that's a huge Prime Air. And I was like, that's the biggest Prime Air plane I've ever seen. He goes, I've never flown Prime Air. I'm like, bro, it's Amazon. And it was a white plane with a blue, Prime on it, but it said A, or Air.
Yeah.
And he goes, oh, dang. Like he's like commercial jet.
Yeah.
He was thinking, and here it is on the middle of the day, because most airlines will take off at night. And here's Amazon competing with all the commercial planes to take off in the middle of the day, because they're moving so much. I mean, their infrastructure is amazing. Yeah. I want them to pay a dividend. I'm not sure they will.
Right.
What else we got? We already talked about
acquisition strategy. Yep. So that's where a lot of capital goes, and you were alluding to some of that. They see a company that's up and coming, and hey, you're doing something great. Let's just go ahead and absorb you and fold that into what we've already got going on.
You've got building ecosystems. You think of like an Apple. That's probably one of the biggest. Google and Apple, one of the biggest ecosystems out there. Microsoft. Where it's just platform development.
Okay, I was going to say, expand on what you mean by ecosystem.
So, like your iPhone, I don't have my phone on me, but like that's an ecosystem. So, I have my store, I have all these apps, I can do everything. Like this is an entire environment that's held me captive. Or, we're a Google Workspace office, so I can log into my Google accounts, I can get to Sheets and
slides.
Whatever they're.
Sheets is what we use.
What's the other one?
I think it's like
Word.
Docs.
Docs? Yeah, Docs.
Yeah.
That's funny. We both freaked out. Yeah, I hear him laughing over there going, they don't know what they're talking about. But, it's this huge ecosystem where we can get to email, and there's so many other tools that we can use. We log in once, and we can go everywhere. With Microsoft, it's, Excel, and it's Word, and it's all these, their mail account. And you're just in this environment where you have access to everything. And that takes a long time. Like we're actually building our own ecosystem here for Insight Folios, for our clients and our advisors. And, we started a year ago. We're probably a year out, probably 6 months before we begin the first part of our single sign-on. And then, by the end of this year, we'll have 5 products on our single sign-on. So it's our ecosystem is, it's baby.
Yeah.
But, the reality is, these take a long time to build, but they're so cool. And they almost held you captive.
Yep.
And that's why so many of these tech companies are so big into...
Makes it super sticky.
Yeah.
Once you get it,
let's do this and this and this. And they're like, well, I don't want to give it up because that's a part of my regimen. This is what I use every day.
I remember, I think it was 5 or 6 years ago, I tried to purchase a Droid-based phone. And they were like, you get 30 days at home. If you don't like it, bring it back. And I literally gave it 3 weeks.
I'm like,
I was like, I can't do this. Like, nothing works the same way as my iPhone. Like, I tried because the phone was actually super powerful.
Yep.
Pictures were amazing. Video was great. It moved so much faster, but just
their ecosystem.
It was not intuitive
different.
At all.
Yep.
The typing, it was funny. And then you build this ecosystem, and you got to do what? You got to market it and go develop
brand
it,
recognition,
and hit sales for it. You got to get people using it.
I mean, everything on here, like this is why most tech companies don't pay, is because everything we've talked about up to this point on a tech company is super expensive. And to our point that we were talking about earlier, like a Facebook or an NVIDIA, not necessarily an NVIDIA. Who was the other one that just announced?
Google.
Google. They're so big and their infrastructure has been so vast, their education, their brand, their platform, like they're to a great point where it makes sense to shift the investor, because all the stuff we're talking about, it's high dollar. Like this is very expensive, but the realities are we've spent so much of our capital building up to this point, 20 years, whatever, 25 years. And now we can convert our shares, our stock, and invite a new type of shareholders. I can see a point, this is hard to think, but like 15 years from now, where 30% of our portfolio is tech dividend payers. And, you look right now, it's like, 3%. And you go, how could that be? Well, utilities are a bedrock. Consumer goods is a bedrock, and technology
is going to be
I mean, it already is.
Correct.
We could not survive without certain pieces of technology for what we do.
Well, and whenever I say them, your Google specifically, Apple,
Big
Microsoft, they have spent the last 20 years building these ecosystems, educating, making them super sticky to where an office like ours isn't just going to up and change. So there is built-in revenue that is going to be consistent, that they can say, oh, this segment of our business can basically fund the dividend because we know how kind of consistent that income is going to be.
Yep.
And then we'll have these flyers, and that can be where our growth comes from. But this consistent business model of the ecosystem and environment that we have people kind of trapped into, we know that can fund it.
So real quick, let's talk about the broader economic trends that are influencing this tech shift to pay dividends. So we've touched on a lot of this already. Market saturation, which means basically we have limited growth opportunity. There's increased competition in our space for the shareholder. So if you think about the Magnificent Seven or companies that are trying to vie into that magnificent whatever the number is going to be, because we changed, right? It used to be 5 and 7. I mean, it's been larger and smaller.
Yeah.
But the reality is, there's a fight, and some of these companies are vying, again, trying to open up to other shareholders. And one of the points that we made earlier, that you made really earlier, is the slower growth rates. Yeah. I mean, these companies are like, I'm not sure we can grow 50%.
I mean, the CEO, the last earnings call for NVIDIA said, hey, I'm letting everyone know
we're at capacity.
We are at max capacity. So please do not put a 50% growth rate on us again this year. Like,
we can't do it.
If something happens, okay, maybe, but he's like, the expectation is not for this insane 300% growth on our stock again. Like, we just can't do it without other investments.
And you look at and I don't want to keep harping on Facebook, but how do they bring in more revenue? Like, how many users do they have? I don't know. I mean, we're getting to the point where they're like 50% of the world's population.
Yeah, 30%. Like it's over 1 billion people use it.
I thought it was more than
active
that.
users. Oh, and that's why I don't know exactly
billions.
Where it's at. Yeah.
And whatever it is, they're getting close to capacity. So you think about how can we grow that? Now they're doing some of these flyers so they can have more streams, and that's where Google became so successful, because they started with search and then they went to phones and ads and TV, cars. I mean, they're AI everywhere. And Amazon's the same thing. Like, you can buy a house on Amazon, you can buy a trinket on Amazon. You can do anything. So I mean, you're seeing these huge companies spend capital to do all kinds of.
And then Amazon even got into like data storage.
They're the largest, I think.
Which is crazy. People don't even think of Amazon as the AWS, but like that's a whole nother line of business for them.
Yep. So they're and I also think one of the big talking points here is changing the investor expectation. Where before they're like, hey, you only buy us for growth. We're going to be the outlier. We're going to go from $5 a share to $5,000 a share, and that, for most of these companies that we're talking about, that's over.
Yeah.
Like, you might, and NVIDIA was one that's been recently, but that wasn't $5 a share before it started its growth run. but we're also starting to see that start to slide.
Sure.
So, this big shift, and we're talking really big tech here.
Right.
We're not talking the next Facebook. We're not talking the next Amazon or Apple. We're just talking about the big tech companies that are positioning themselves to start paying a dividend, or are now paying the dividend, or paying a dividend.
Do you think like the interest rate environment is having anything to do with this? Where it's like, hey, we can't really, like, we don't want to take out these massive loans to go invest in whatever. So instead of doing that, let's just kind of tighten up. Yeah, let's tighten up our investors.
I think interest rate environment has completely played a role in some of these tech companies picking now to start paying their dividend.
Yeah.
And I think it's also a precursor of potentially what they see ahead in some of the volatility, economic downturn. I'm not trying to scare anybody, but I'm a little pessimistic on how strong our economy is. Well,
that's why my antenna went up whenever I started hearing not one but two, and it's like, hold on, you guys are starting to pay a dividend. That typically means we're trying to hold on to some of these investors. Yep. We don't need y'all going away just yet.
Last thing I'd say here is probably regulatory, political pressures that they're probably, some of the things that we're not necessarily seeing that's happening in the marketplace, which is another reason why some of these companies are paying a dividend. So some of the things that we want to talk about, what are these companies, or what are these tech companies that are paying? So we've mentioned a bunch of them already. Microsoft was probably the first big one back in the 90s. Mm-hmm. Then the next big one, notable one, was probably Apple in 2007. NVIDIA has been paying a dividend for a long time, but it's like a couple cents. That I'm not even
especially
sure.
with the share price so high. It's like,
not even sure we would consider that a dividend payer, but it actually is paying a dividend. Yes. And then recently we've had Facebook and say they're going to start paying a dividend earlier this year, and then really recently it's been Google.
Yeah, just this last week.
Yeah, so the realities are more and more of the big tech companies are shifting, and we're not necessarily jumping on that bandwagon. No. Although we do own some of them, but the realities are we're starting to see it. We're excited to see it because these are bedrock companies. They're not going to be going away anytime soon. There will be fluctuation. The price is going to go all over the place. But how great would it be to own an Amazon or an Apple or a Microsoft, which we own, that pays a great dividend, and then you can see consistent, probably year over year, 20-25% growth, and get to cash in on some of their profit. That's pretty strong.
Yeah,
that's exciting.
And the ability to reinvest that dividend is awesome. Always awesome. Yeah.
So give me your predictions, and then we'll shut this thing down. And predictions, and what I'm talking about there is, if you were to think out, we've kind of alluded to this already, but if you were to think out, like, what you think is going to happen in the tech sector, and when I say tech, I'm really thinking, NASDAQ. What's going to happen with the new culture of dividends infiltrating that industry?
Yeah, I think they're setting the stage for more dividend payers to come out of the NASDAQ, especially as it just becomes a more mature category. Mm-hmm. I mean, tech's kind of always been around, but it's had its time in the spotlight the past 20 years or so. And this insane growth, it just becomes so big that you cannot repeat it year over year over year. And I think a lot of these companies are just getting out in front of it and saying, hey, we recognize we're up against some big percentage growth, but we would still like to retain some of you shareholders. So we're going to start rewarding some of that. The biggest thing for me long term will be, do they integrate it into the DNA of the company? Because that's such a big thing for how we evaluate companies. Is it something that they just keep the same, and it's just kind of this flat dividend they pay, $2 and it's always $2, or do they slowly increase it, allow it to be something that's really part of the DNA?
My prediction on that is it's inevitable, because if you look at what happened with Microsoft, it has become a core to their stock.
Yeah.
And why it becomes core is because of their employees. because the employees start getting these stock grants, these stock options, and they start looking at their 401ks, and there's been some regulation around that, but you start to see what's happening, or these employees start to see, and they're like, man, I made $17,000 in just dividend last year on my Microsoft account, Microsoft stock, and my grants and this and that. And they're like, they'll start to see that they're never going to sell their stock. And these employees, the shareholders, everybody's going to be like, keep raising your dividend, keep sharing. And that's what happened with Microsoft. That's what happened to so many of these other utilities and stocks that we've talked about throughout the show. I think it's inevitable. Apple, I bet you they're dangerously close to that being part of their culture. Mm-hmm. It's still not that talked about, but they've been consistent payer, consistent increaser. And I think they're following in the footsteps of their rival Microsoft.
Yeah.
And we'll see. It's way too early on the Facebook side. And what's going to happen with Amazon or Google. I think Google's going to follow in their footsteps. They're so massive. We'll see with Facebook. Yeah. I don't know their long-term viability because they're generational. Like that tech, unless they can reinvent themselves, they're going to be the next, what was that, MySpace or whatever?
Yeah.
My
kids don't use it.
Yeah, my kids don't use it.
Yeah.
They're like Facebook. My kids have never used it.
Yeah. Now, that's for you guys.
Yeah, like our generation,
like companies
older,
use it.
They'll use it, and that's it. So there's a life cycle there. They have to reinvent themselves. And I think they are with the Meta, which is great. But I just think they're way, way, way ahead, and they're spending way too much money.
Yeah.
So my forecast is it's going to be a staple. I think tech is going to turn into a much stronger holding dividend payer sector. I don't think we're going to look at the tech sector as just growth. I think we're going to look at it as growth with dividend, and I think over time it's going to be dividend. And I think we're going to end up compartmentalizing big tech versus other tech, where you're going to have these echelon of whatever they qualify, and it's going to be broken out, where it's almost going to be a subcategory where there's the dividend tech payers, and then everybody
like the
else,
startups,
and that's what you want, and I would want a mix of that, just like we want to add in all these other companies that we have to our portfolio for growth, for diversification, and I'm excited about it. I'm like, start paying, attract me, give me a reason to. Throw some money into that.
Yeah.
You got to pay a little bit more than you're paying now.
Yeah.
But
0.5% doesn't really move.
You got, some raise it. I mean, just get me to like 2.
Right.
Like I'd be okay with some of these companies in a few of our portfolios, even if they were at 2%, because of the growth potential and the diversification of what they pay.
Right.
So this has been good. This is
awesome.
Fun conversation. So hopefully you learned a little bit today. If you need anything, any questions that you have, you can always reach out, and we'd happy to go over that. Or if you have any ideas on shows of topics that you want to learn about, reach out to us. We'd love to put a show together about that. Most of our shows come from either people we know or conversations that we have as we take walks just about every day.
Yep.
So God bless. Hope you enjoyed.